Hello, my name is Brayden Muller. I'm an accounting student in Accounting 311, Intermediate Accounting, and I'm going to be presenting my database research project. So this is the financial analysis of NVIDIA, Intel, and Apple, all three of which are tech companies. However, they each specialize in their own area of the market, so they are easily comparable, but there are strengths and weaknesses to each one. So first up is the project goals. I'm going to display patterns and ratios regarding each company's financials. Then I'm going to compare and contrast each measurement from every company to display which one is doing the best in that measurement. Then I'm going to display each company's strengths and weaknesses, which will tie into the compare and contrast as they each will specialize in each individual area of the market. And then finally, in the conclusion, I'm going to discuss what company is the most successful in the long run. So the description of the project is after collecting all required data from the Wharton database, I was able to use such data in order to create these measurements and ratios showing the successes and failures of each account. So competitive analysis. In the case of competitors, each of these corporations compete with each other to design and develop technology and programs. The strengths, each company works in the same sector. However, they each specialize in their own area of the market, such as programs, physical inventory, or a mix of both. And the weaknesses, each company holds their own competitive strategy. So naturally, they will outperform competitors in certain areas and underperform in others. So the next few slides are going to be liquidity ratios. And liquidity ratios are financial metrics that measure a company's ability to meet its short-term obligations using its most liquid assets. These assets are crucial for assessing a company's financial health, particularly its ability to pay off current debts without needing to secure additional financing through a initial issuing of stock. So the first liquidity ratio is the current ratio. This indicates the company's ability to pay its short-term obligations with its short-term assets. A ratio above one is generally considered to be healthy. As you can see, Apple is the only one that is directly underneath that ratio of one. And that's because Apple is considered heavily to be a cash cow, which would mean the majority of their assets are not tied up in operating activities such as inventory. Instead, the majority of their assets are tied up in investments and securities in other corporations, which is why the ratio is below one, because the majority of their assets are tied up in long-term assets. Um, Intel, as you can see, they are still a tech company. However, the majority of their products are physical inventory instead of the programs, which is the case of NVIDIA. Intel produces processing cores, which are in hundreds of millions of computers. And because of this, a high level of inventory has to be maintained. NVIDIA has the highest ratio because the majority of their products only need to be produced one time, and then they can just sell the right of use. So the majority of their assets really don't need to be tied up, right now in the current area. Next is the quick ratio, which is very similar to the current ratio. However, it excludes inventory. So it cannot be easily converted to cash, just like the current ratio as well. Um, Apple did take a dip, even though the majority of their assets are tied up in the long run or in the long term. But they took that dip because they do still have a lot of current inventory tied up through the case of phones, computers, headphones. You can see Intel took a very dramatic dip, and that's because the majority of their assets are, in inventory. NVIDIA did still take a dip because they do manufacture computer parts, but as you can see, they're the only one that is still above that, um, that one ratio. Um, So next are solvency ratios. which are financial metrics that assess a company's ability to meet its long-term debt obligations and remain financially stable in the long term. So these ratios focus on the company's overall financial leverage, capital structure, and the proportion of debt used to finance the business. Um, High solvency ratios indicate a lower risk of default, while lower ratios suggest a higher financial risk. So debt to equity. As you can see, in the long term, as I was saying earlier, Apple has a lot of assets in the long term, which would mean their ratio is exponentially high compared to Intel and Nvidia. Intel, they are in the long run, their growth rates are pretty high, which would explain them having a higher debt to equity ratio than Nvidia. Um, but Nvidia, they have to leverage a lot of their assets through debt in order to actually produce these programs. They hire a lot of programmers and go into debt in order to create these programmers. Even more so when it comes to manufacturing those computer parts, they have to incur debt in order to actually use the processing facilities in order to manufacture their products. So times interest earned. This indicates the margin of safety for shareholders' investment. You can see Apple is very high, and that's because a lot of their cash is tied up in their own investments. So meaning that the success of Apple itself is not it doesn't directly correlate just to the success of their business model. Instead, it kind of just rises with the market itself, judging on their own investments. Intel is actually in a negative margin of safety, which is not a great tell for investors. And Nvidia right now, Nvidia just recently had a stock split. I believe it was a 20-to-1 stock split, which is why right now the Nvidia stock is rising incredibly fast. And because it's growing so fast, it's indicating a high level of safety for shareholders. So the next few slides are activity ratios, which are also known as efficiency ratios or asset management ratios. They just measure how effectively a company uses its assets to generate sales and revenue. These ratios give insights into how well a company is managing its resources, such as inventory, receivables, and fixed assets to support its operations. Higher activity ratios generally indicate efficient management of resources, while lower ratios may signal inefficiencies. So we'd be looking for higher ratios than lower. So asset turnover, which measures a company's efficiency in using assets to generate revenue. You can see Apple, they do manage their assets efficiently and have above that 1 ratio. And that is because they do still have that, physical inventory. And with their long-term assets, they're still managing to, produce a good amount of profit and revenues, regardless of those long-term asset obligations. Intel is still turning profits and revenues, however, just not quite as fast as Apple and Intel. And because NVIDIA only sells really, online programs, which is not only, but the majority of their products, they're very easily able to generate profits as they don't need to spend a lot of time in, operating expenses. So that's why their ratio would be much higher than the rest. Next is receivables turnover. And this indicates how quickly a company is able to collect its accounts receivable. So in the case of a major corporation, owing, Apple, Intel, or Nvidia money, it just indicates how quickly they're able to actually receive that money. Apple and Intel are very similar in this case because other companies will, buy Apple and Intel products, whether it's for, just business processes, computers, and stuff like that. But in the case of Intel, a lot of their products directly tie into other, manufacturing products. So Microsoft, they will, buy Intel processing cores in order to put into their computers. Apple processes their own, um, as opposed to, other of these major computer companies. Um, NVIDIA has a exponentially high, incredibly high receivables turnover ratio. I would assume this is because NVIDIA's largest um, customer is actually the US government. Because of that, it's the US government. They will have plenty of cash that are, they're able to, really hand over. In the case of a national budget, um, that's something they actually have to budget for, and they're required to actually pay that. Um, so yeah. Next are profitability ratios, which are used to assess a company's ability to generate profits relative to its revenue, assets, equity, or other financial metrics. These ratios provide insight on how effectively a company is converting sales or assets into profits, and they help investors, analysts, and managers understand the company's financial performance and its ability to generate returns. So, in the case of gross profit, any company could really turn a gross profit. However, after interest expenses, paying off debts, receivables, if they're not able to retain a net income or profit after keeping a good gross profit, um, it would show a lack of ability to be profitable as an entire company. So the first is the gross profit margin, which is one of the first things a investor would really look into. Shows the percentage of revenue that exceeds the cost of goods, indicating the efficiency of production and services. So these are percentages. You can see Apple has a 0.46% or a 46% gross profit margin, Intel at a 57% profit margin, and NVIDIA at a 75% profit margin. NVIDIA, because they sell majority online programs, they do not have to spend a lot of time or money in operating expenses, which is why they're able to hold a good gross profit margin. Um, Intel and Apple, however, they have a lot more manufacturing they actually have to, pay for, which ties into the, gross profit margin. Next is the operating profit margin. This reflects the profitability from core business activities before interest and taxes. As you can see, Apple and NVIDIA, they both have, relatively solid operating profit margins. But in the case of Intel, they are very, very low. In fact, they are at a 3%, operating profit margin, which is not great for the long-term longevity. Next is net profit margin. This indicates the percentage of revenue that results in profit after all expenses, including taxes and interest. As you can see, the net profit and operating profit margin are actually the exact same measurements. NVIDIA has the highest net profit margin, which is understandable. They don't have a lot of operating expenses that really have to go into it other than, um, paying their, employees. Apple has to, spend a lot of time in materials and processes in order to actually generate their, production methods. Intel, on the other hand, yeah, they have to spend a lot of money because the majority of their inventory is all physical. It's not online programs. Obviously, they have patents and trademarks on all of their processors. Um, but yeah, the majority of it is just sold directly into the, rights of use for the processors. So here's the profit margin on sales. This measures the amount of net income achieved per sales dollar. I believe. Oh yeah. So with the net income achieved per sales dollar, that just shows really how much money they're able to make after the operating expenses, the taxes, and all that. The amount of money they're really able to keep after the per sales dollar. So Apple is able to incur 25 cents, Intel is able to incur 3 cents, and Nvidia is able to incur 48 cents, it seems. So ROA, return on assets, measures how efficiently the company uses its assets to generate profit. This is actually a very important, measurement when looking to invest in a company. With Apple at a 0.282, Intel at a 0.012, Nvidia at a 1.121. So Nvidia is much higher than the other two. I believe that's just because they do not have to worry about the physical inventory part. Whereas Apple has a little bit higher as a lot of their assets are tied into the long term. But Intel is not. Return on equity. So this reflects how well the company generates profits from its shareholders' equity. Apple is at a 1.105, Intel is at a 0.021, Nvidia at a 1.812. So this comes directly from the investments from its shareholders. And Apple is able to use a lot of those investments to tie directly into their long-term investments, which is why a lot of Apple investors from the long term have received really incredible gains, in the last, 15, 20 years. Nvidia right now is really high just in the market in general, which is why their return on equity is, a little bit higher than Apple's. But in the long term, over the last, 20 or so years, Apple has been a substantially high return on equity. Equity multiplier. So this measures the amount of assets that are directly financed by shareholders. So as you can see, Apple is much, much higher. That's because a lot of their investments are invested directly into, their own long-term investments. The majority of, the shareholders right now, with all their money going into there, Apple is able to use their, operating income and net income from, gross profit in order to just continue its business operations. And they're still able to maintain a profit after that. Intel has a 1.753, and Nvidia at a 1.616. So Intel and Nvidia are relatively close, but Apple is exponentially higher. So the DuPont framework measures the overall financial performance of a company. However, this does not show the, growth rates or anything like that. Really, it just shows, how they're doing in the current year. Intel right now is much lower than the other two. And, this is just a really, great measurement to look at when you're, you know, thinking about investing. Intel right now it seems to kind of be at a standstill. They are a mature company, so they are a relatively safe investment. But as of right now, it seems like their, long-term growth has kind of halted. Um, Apple is still growing, of course. However, their, stock and all that has not, grown too much in the past, 5 or 10 years. They're much more of a long-term growth corporation. Whereas the case with Nvidia, after their stock split, you can just see the amount of profit they've actually been generating. So the next are leverage ratios. These assess the degree to which a company is using borrowed funds or debt to finance its operations and growth. These ratios measure the company's financial risk, specifically the risk of not being able to meet its debt obligations. Companies with higher leverage are considered more risky, and they have a higher proportion of debt relative to equity or assets. However, using leverage can also amplify returns when the company is successful. Um, yeah. So debt to equity, as you can see, Apple apparently has a lot of debt. Intel is at a 0.452, and Nvidia is at a 0.257. So just based on this ratio, you can see Nvidia is the safest of the three to invest in, and Intel is not. Or Intel is, second up. Apple is the most risky in the moment. Um, and yeah. So the debt ratio, this indicates the proportion of assets financed by debt, with a higher ratio suggesting a higher financial risk. As you can see, Apple is still higher. Um, Intel is relatively the same, and Nvidia is still the lowest. So Nvidia would still be the safest choice for investment. Um, and as you can see, a lot of Apple's assets are financed by debt. That's because, their long-term assets are directly financed by their shareholders. They just invest the investments they're getting directly into their own long-term securities. Interest coverage ratio. So this shows how easily the company can meet its interest payments with its operating income and not have to, tap into their cash balance. Apple is able to do that very well. Intel, on the other hand, is not. So Intel has been tapping into their cash balances in order to just cover their operating expenses and their interest payment. Nvidia, on the other hand, has proven to be extremely profitable and is able to do that 128 times over, which is quite impressive. So next are the market ratios, which are market based or evaluation ratios, which are financial metrics used to assess a company's market value relative to its financial performance, earnings, and stock price. These ratios help investors determine if a stock is overvalued, undervalued, or fairly valued in the market. Market ratios are typically used in stock market analysis to compare the market price of a company's shares with its financial metrics. So price to earnings. So this shows how much investors are willing to pay for each dollar of earnings, reflecting market expectations for growth. So Apple, they're willing to pay, investors are willing to pay a lot more in order for, $1. The reason for that is because, Apple generally grows with the overall market. And that's why it's a, safe long-term investment. Intel, not so much. Intel, they are looking for, short returns, and really just safe returns. Nvidia right now is a little bit higher, still a, safe investment, but not nearly as much as Apple. So earnings per share. This indicates the portion of a company's profit allocated to each outstanding share of common stock. Um, so you see Apple for every stock that, or yeah, each individual stock they sell, they will earn, $6. Intel earns 39 cents and Nvidia earns $12. Um, Currently that's because Nvidia's, stock split. I believe that happened 2 or 3 months ago. Yeah, their stock split has helped them, have a very high earnings per share. So the price to book ratio. So this compares the market value of a company to its book value. So this shows investor sentiment regarding the company's net worth. Um, Apple right now has a very high price to book ratio. Um, Intel is, still a safe price to book ratio, but nowhere near as high as Apple and Nvidia. So lastly are the growth ratios, which are used to evaluate a company's ability to grow over time, particularly in terms of its revenue, earnings, and market value. These ratios provide insight into how well a company is expanding and whether its growth is sustainable. Growth ratios are often used for investors to assess a company's potential for future growth and to make comparisons between companies within the same industry or sector. So yeah, these are one of the most, important ratios to really look at for investors. Um, when it comes to the stock market, there's a lot of different strategies on investments. However, long-term growth is a very sustainable, area to look into to invest. So this one is this is the revenue growth rate, which measures the year over year growth in revenue. So these ratios, right here, these growth rates are only for the past 2 years. So decided to include a graph to show the year over year. This graph is not standardized, so you'd have to actually look at, each individual, company. Um, as you can see, NVIDIA over the past year had a very, very high growth. And both Apple and Intel, their revenue growth rates are actually in the negatives. So they've taken dips over the past, year and a half. This does not include 2024, however. Um, in fact, Apple does include 2024. Intel and NVIDIA have not. So NVIDIA could still take a small dip and Intel could rise. Next is the earnings growth rate. So this is just, how much they're actually earning, you know, after, all their operating costs. Apple has lost 0.004. Intel has earned, 2, and NVIDIA is at 73%. Their earnings are incredibly high compared to Apple and Intel. So the conclusion with the high level investments and cash on hand, Apple is the most profitable company. However, when it comes to the rate of revenue growth, earnings per share, and the return on assets, NVIDIA is the fastest growing corporation and is currently the best choice for investing. If you're looking to invest in something right now, NVIDIA is the best stock on the market to really, look into for investing. So that's my conclusion. I'm Brayden Muller, and thank you guys for listening.